First of all, so let me finish off. This is the fifth type of analysis, so 5 to 10 minutes should be okay. Number one, gold has been in a secular uptrend for 7 years. That one you saw in the first section. Number two, gold is rising up against all fiat currencies. So that's number two. Number three is understanding that gold is seasonal. That happens. And number four is gold prices always fall 15 to 25% on a regular correction that occur anywhere between 12 and 24 months. So anytime you see the gold price fall 15%, please don't get scared. There's nothing to scare about. Gold price falls up 15%. What do you women do when you see the shirts, or whatever, the skirts 15% off? You go and get some more of it. I mean, well, bread is cheaper 15%. You go and rush and get two. Meat is cheaper 15%. You get some more. So this is the way to approach it. Not the other way around. Gold price falls 15%. Everybody gets scared, say, well, let's dump the whole gold. Well, that's not the smart way to invest. In this particular case, the women's intuition is a lot better than investors' rational thinking. Well, the answer is that when the price of gold falls, investors lose rationality and act impulsively. All right? So let's see, what do we have here? Well, that's the technical analysis. Again, the repetition. This is here the first or the previous gold bull market from 70 to 1980. And you can see price rising. This is here in between the secular bear market where gold distinctly underperformed. And now I have shaded for you the new latest bull market, which in my opinion, as I began early on, I expect to last another 5, 10, possibly 15 years from here on, for a total of anywhere between 15 and 25 years. This is a good chart to see that, again, this is only from January 2004 all the way to November 2008, so up until just 3 months ago. And price of gold is fixed at 100% for each of the major currencies in Swiss franc, Japanese yen, US dollars, euro, and British pounds. For these 5 major currencies, the point to see here is that the price of gold has been rising in all currencies. A different way to state the same thing is that gold has been outperforming all currencies. Now, the correct statement, of course, is completely different. The correct statement is that all currencies are falling up against gold because the value of gold changes little. It's that paper currencies lose purchasing power because governments print and create more of them. All right? Any questions here? I have 1 or 2 more charts and I'm going to be done. All right, well, you also got to understand that this is the seasonal pattern for gold that is extracted over the last 38 years. You see that for some months like January and May, you have from month to month a very significant rises. I mean, 3% return in 1 month annualizes to 40% annual. So 3% return is a huge cyclical movement. 3% in 1 month. We're talking in May, 4%. If you just buy at the beginning of May and sell at the end of May, and there you have your 4%. At least expectation based on 37 years. And of course, you do have bad months like February and November. So if your gold doesn't move in these months, it is natural, at least based on 37 years of history. All right, now I'm just showing as one example. I usually show for each currency a separate chart, but only for euro because usually we don't have time. You see that euro held steady, gold at roughly 60, 365, all the way to 2006. And then in 2006, the price of gold shot up in euro to, you can see, all the way to 600 euro. And then it consolidated. And in the latest credit crunch since July or August. Gold price has gone up all the way to 650 euro. From this perspective, it is incomprehensible why I hear constantly that the euro was strong and that the euro was solid and stable currency when obviously it is not. I mean, prices of oil are skyrocketing in euro terms. Prices of houses, of everything is going up. How can it be that all prices are going up big time in euro and yet the euro is stable? Well, the answer is it is not stable. We're just told that it is. Let's see. How to invest in gold, different forms. Probably I'm going to skip this part. You have some gold certificates, you have gold accounts, you have storage at bullion banks, you have gold mining stocks, gold spread betting, gold derivatives, gold ETFs. There is one very important thing to understand gold. Well, the most important thing. All of these represent financial derivative, financial instruments. These all represent a claim for gold on somebody else. If that somebody else goes bankrupt, then your gold evaporates. I mean, it's gone too, meaning you don't have gold. You thought you had it, but you didn't. It's kind of like you think you have a house, but you come back and it turns that your house collapsed. It's the same thing. You know, will be a devastation for your finances. The only safe way to invest in gold is when gold is in your possession, you have it fully paid, it is not mortgaged, and it is somewhere safe with you. I mean, in your house and not. I mean, it's a completely different lecture we should make about 101 ways on where to hide your gold, where to stick your gold, so that when the thieves come, they cannot actually find it in order to steal. It's a completely different lecture. I mean, I've come up and I've read a lot, but I think that's good enough. And the overall conclusion for today is that currently all different types of analysis, cyclical, fundamental, portfolio, behavioral, technical, all suggest that gold at this point in time for the foreseeable future, 2, 5, 8 years, is an outstanding buy, is a great investment as a long-term investment. And I can't tell you anything how it's going to do next week based on, that guy. I don't know. Even in 1 month, I don't know. But the fundamentals are rock solid. We know China and funds and everybody else will keep buying gold because there's not much else to buy. So, if you just want to have a little bit of a diversified portfolio like this one, you just put in 5 or 10% and you're fine. If you want to have a more balanced portfolio, you definitely want to have 10 to 15%. If you certainly want to have an aggressive portfolio where you're going to be betting on doing something more with gold, meaning get some good returns and a big chunk of your portfolio has to be in gold, then you can go all the way to from 20 to 40%. And then if you're investing for a crisis, you'd better have at least 50 to 80%. My personal portfolio is roughly 40% gold, 40% silver, 20%, about 20-25% real estate. I don't own any stocks. I don't own any bonds. I don't own any financial assets. I have a little bit of money in the bank, meaning I have very little cash. Anytime I get some, I walk in and somewhere get buy a coin. So I try to convert my cash as soon as I can from Bulgarian currency always into euro, and when I get a decent amount of euro, maybe 1,000, maybe 2,000, I go and convert it into gold or silver. But that's how I personally manage my own personal finances. You guys will have to decide on your own. All right. Well, thank you guys. So we're done.
Ja meil on aega veel kuskil 2 küsimuseks sellele sädelevale esitlusele sama sädelevat küsimust juurde esitada.
If they have any final questions, because I will be catching a plane to Bulgaria. And I told them, first thing I'm going to do is write an article about the Estonian miracle, economic miracle, right? So I'm going to be writing an article on that and say, hey, this is how their streets are a lot cleaner and bumps and all this kind of stuff. So, well, questions?
How long will last current economic crisis, and which will be the maximum price for the gold during this crisis, in your opinion?
Okay, okay. Let me put it this way to see the precision in your question. Let's say 100,000 billion Zimbabwe dollars. Is that good enough answer? All right. It's going to be 100 million Turkish liras. Is that good enough? So.
In US, $8.
Okay, so when you're asking about the price of gold, you must always ask, and the answer is, if it's going to be in oil, probably a little bit up. In dollars, it could double or triple from here, so 2,000 or 3,000. But back to the question of the crisis. I'm teaching right now about half a course on the current credit crunch. That's what I do in current topics in international finance. We're probably a quarter to a fifth from the beginning, and we've run about 9 months this credit crunch. We haven't seen yet credit cards blowing up and causing damages to financial. We haven't seen auto loans blowing up and causing the damages. We haven't seen yet student loans blowing up and causing the damages. We haven't seen yet commercial real estate blowing up and causing the damages. We have an $11 trillion corporate bond market, and there are about 10 times more to recognize within the next 3 to 5 years. So unless and until you see all of these losses well recognized, you're still going to be in a credit crisis mode. So a reasonable expectation is anywhere between 3 to 5 years. And it's going to feel more and more painful as the US economy continues to slide deeper into recession, as the Eurozone slips into recession, Japan, etc., etc. So let me put it differently. Short answer is we're barely at the beginning and we have a lot more to go, if that's answering your question. Is it?
Nii, loodame, et see vastus publikut rahuldas ja me peame tänaseks lõpetama, aga 6 kuu pärast on meil lootus võib-olla teda veel kuulata ja jälgida, mis siis ikkagi maailmas toimub. Ja kui hästi siis nagu Wall Streetil teatatakse, et kui hästi olukord jälle paremaks on läinud. Aitäh! Thank you!
Yeah. Well, I don't understand Chinese. All right. Okay, thank you.